This episode is about childcare, relocation, and company-paid life cover. Used properly, arrangements like these cut real household and employment costs instead of adding to a tax bill. But each one carries conditions worth checking first. We will look at three. First, tax-free childcare, then qualifying relocation expenses, and finally company-paid relevant life cover. Some valuable tax advantages do not involve taking extra cash from the company at all. They reduce major household or employment costs instead. Tax-free childcare is a personal government scheme available to eligible working parents, including employees, directors, and the self-employed. For every £8 paid into the childcare account, the government adds £2. The maximum top-up is normally £500 every 3 months, or £2,000 a year for each child. For a disabled child, the maximum is £1,000 every 3 months, or £4,000 a year. The money must be used with an approved childcare provider. Eligibility includes work and minimum earnings conditions, the child's age, and the income of both partners, where there is a couple. Broadly, neither parent can expect adjusted net income above £100,000 for the tax year. Adjusted net income is not always the same as salary or total cash received. Certain pension contributions and gift aid donations can reduce it, but do not delay or manipulate income purely to preserve childcare without calculating the wider tax and cash flow consequences. Eligibility must be reconfirmed and can be lost if either partner exceeds the limit. Next are relocation expenses. An employer can cover up to £8,000 of qualifying relocation costs without tax or national insurance, where the conditions are met. This can apply when a new employee moves to start a job, or an existing employee changes their normal workplace. Qualifying costs can include moving expenses, certain costs of buying or selling a home, some replacement household items, and qualifying bridging finance. The employee's new home must be reasonably close to the new workplace, while the old home is not. The costs must normally be paid by the end of the tax year, following the tax year in which the employee starts the new job or workplace. This is not a general £8,000 moving allowance. A director cannot decide to move house for personal reasons and simply charge the company. The move must be connected with the employment change, and each cost must fall within the qualifying categories. Finally, relevant life cover can be useful for small companies that do not have a group death in service scheme. A relevant life policy is generally an employer-funded life policy covering an employee or director. When correctly structured, the premium is not normally treated as a benefit in kind, and the eventual death benefit can be paid through an appropriate trust rather than directly into the employee's estate. However, 3 common claims need qualification. First, corporation tax relief is not automatic. The premium should form part of a commercially reasonable remuneration package and satisfy the wholly and exclusively test. Second, the policy must meet the statutory conditions for relevant life cover. Third, the inheritance tax result depends on the policy and trust being established and administered correctly. The old claim that relevant life cover avoids the pension lifetime allowance is also outdated because the lifetime allowance was abolished from the 6th of April 2024. Modern pension lump sum and death benefit limits still exist, but relevant life cover is separate from ordinary pension saving. These benefits can be powerful because they solve real needs: childcare, moving for work, and protecting a family. The next episode turns to difficult trading periods and explains how losses, side hustle income, and reinvestment are actually treated. For guidance on company-paid benefits and eligibility, contact ABC Business Services. You can speak directly with a member of our team, email us to arrange an appointment, or visit our website for more information.